Are you prepared to navigate the challenges of buying a home in a high-stakes market? Picture this. You find the perfect house, but you're up against multiple offers, rising interest, and a market that seems to be moving at lightning speed. Feels overwhelming, right? Don't worry, because today we're going to arm you with insider tips and strategies to not only survive but thrive in this competitive market. We're going to turn those for sale signs into sold signs, and we're going to do it together. Hi everyone, welcome to Smart Moves with Vibha. I'm Vibha, your trusted real estate expert in Northern Virginia. Today we're diving into one of the most pressing questions on every buyer's mind. How do I successfully buy a home in a hot market, especially with high interest rates and a competitive market? We're going to explore rate buydowns, ARMs, negotiation tactics, and even how to use an escalation clause to your advantage. As your dedicated real estate expert, I simplify the complex buying process, offering strategic insights and tailored solutions to secure your ideal home in Northern Virginia's competitive market. We're not just going to talk about theory. We're going to give you real actionable steps that you can use right now to win your dream home. So let's get started. Let's begin by exploring some smart financing options in today's market. Getting creative with your mortgage can make all the difference. Explore rate buydowns. A 2-1 buydown allows you to enjoy a reduced interest rate for the first 2 years before it adjusts to the full rate. A 3-1 buydown extends that to 3 years. Now, let's look at some examples to make these buydowns crystal clear. Imagine you're buying a home and your lender offers you 6% interest rate. With a 2-1 buydown in the first year, your interest rate would be reduced by 2%, bringing it down to 4%. In the second year, it would be reduced by 1%, making it 5%. From the third year onwards, your rate would be the original 6%. So if your normal monthly payment would have been $1,800, it would be reduced to $1,500 the first year and $1,650 the second year. Now, with the 3-1 buydown, the rate reduction is spread over 3 years. In the first year, your rate would be 3% lower at 3%. In the second year, it's 2% lower at 4%. And in the third year, it's 1% lower at 5%. Then from the fourth year on, it's the original 6%. So if your normal payment would have been $1,800, it would be $1,350 the first year, $1,500 the second, and $1,650 the third. These buydowns can significantly lower your monthly payments in the initial years, making home ownership more manageable. And remember, these costs can be often negotiated with the seller, making them even more attractive. However, one thing to remember, not all sellers offer buydowns, which might limit the buyer's available property choices. Also, this would be best suited for a buyer who anticipates significant increases in income in the coming years. Consider adjustable rate mortgages, ARMs. ARMs offer a lower initial rate for a set number of years like 2, 5, 7, or 10 before adjusting. What are important things to consider for ARMs? A yearly cap after the fixed period and a lifetime cap. If you plan to move or refinance within that period, an ARM could save you significant money. Now let's see how a 2-1 ARM stacks up against a traditional 30-year fixed mortgage. With a 30-year fixed mortgage, let's say you secure a 6% interest rate. Your monthly principal and interest payment would be approximately $2,530. This payment stays the same for the entire 30 years. Now with a 2-1 ARM, you might get an initial interest rate of 5.5%. For the first 2 years, your monthly payment would be around $2,270. After 2 years, the interest rate will adjust. Let's assume it adjusts to 7.5%. Your payment would then increase to approximately $2,800. If rates continue to climb, your rate would continue to go up. But if rates go down, your rate will go down. So in the short term, the 2-1 ARM offers lower payments, which can be attractive. However, you need to be prepared for potential increases in the long term. If you plan to sell or refinance within the initial 2 years, the ARM could save you a lot of money. However, if you are looking for long-term stability and predictable payments, the 30-year fixed might be a better choice. Another strategy is to negotiate for sellers' concessions. What exactly are they? Sellers' concessions are essentially agreements where the seller agrees to pay for certain costs on behalf of the buyer. This can include things like closing costs, the fees associated with finalizing the real estate transaction, buyer agent fee, any negotiated buyer's agent fee between the buyer and their agent, rate buydowns, paying points to lower the buyer's interest rate, prepaid items such as property taxes or homeowner's insurance, home repairs or upgrades, addressing issues found during the home inspection in markets with less competition or when a seller is motivated to close a deal. You can often negotiate for these concessions. This can slightly reduce your upfront costs and make homeownership more affordable. Buy less than you qualify for. Staying below your maximum budget gives you financial flexibility in a high-rate environment. Why is this so important? Well, in a market where interest rates are fluctuating, your monthly payments can become unpredictable. By choosing a less expensive home, you create a buffer. This buffer allows you to absorb potential increases in your mortgage payments without stretching your finances too thin. Plus, it frees up cash for other essential expenses like home maintenance, unexpected repairs, or even build-up of your emergency fund. Let's delve deeper into some of these crucial strategies for navigating a high-rate market. Make a larger down payment. A bigger down payment reduces the loan amount, lowering monthly payments and the overall interest paid. For instance, if you're buying a $500,000 home, a 20% down payment is $100,000, leaving you with a $400,000 loan. Now imagine you increase the down payment to 25%, which is $125,000. Your loan amount drops to $375,000. This smaller loan means lower monthly payments, and over the life of the loan, thousands of dollars in interest savings. Plus, a larger down payment can make your offer more attractive to sellers, showing them you're a serious buyer with strong financial footing. An important strategy is to improve your credit score. A higher credit score qualifies you for better rates, pay down debts, and resolve credit report issues before applying for a mortgage. Even a small improvement in your credit score can make a significant difference. For example, if your credit score jumps from 680 to 740, you could qualify for a significantly lower interest rate. On a $400,000 loan, that difference could translate to hundreds of dollars in monthly savings and tens of thousands over the life of the loan. Start by checking your credit report for errors and disputing any inaccuracies. Focus on paying down high interest credit card debt and avoid opening new lines of credit in the months leading up to your mortgage application. Shop around for lenders. Compare rates and terms from multiple lenders. Don't settle for the first offer. Lenders offer different rates and terms based on their risk assessment and the business models. Get quotes from banks, credit unions, and online lenders. Use online comparison tools to see a snapshot of available rates. Even a 0.25% difference in your interest rate can save you thousands of dollars over the life of your loan. Don't forget to factor in lender fees and closing costs when comparing offers. Lock in your rate. Once you find a favorable rate, lock it in to protect yourself from further increases while you finalize your home purchase. Rate locks typically last for 30 to 60 days, giving you time to close on your loan. If rates are trending upward, locking in the rate can save you from paying a higher interest rate later. However, if rates drop, you might miss out on a lower rate. Weigh the risks and benefits carefully. Refinance when rates drop. Accept the higher rate temporarily, knowing you can refinance if rates decline in the future. Keep an eye on the market trends and interest rate forecasts. When rates drop, consider refinancing to lower your monthly payments and save on interest. Be sure to factor in the costs of refinancing, such as appraisal fees and closing costs, to ensure it makes financial sense. Consider a shorter loan term. A 15-year mortgage often comes with lower rates compared to a 30-year loan, potentially saving you money in the long term. But remember, this will increase your monthly payment. For example, a $400,000 loan at 6% interest would have a significantly higher monthly payment on a 15-year term compared to a 30-year term. However, you'll pay off your loan in half the time and save a substantial amount of interest. Consider your budget and financial goals before choosing a shorter loan term. Budget for a comfortable payment. Account for property taxes, insurance, HOA dues, and other costs to avoid overextending yourself. Don't just focus on the principal and interest payment. Factor in all the recurring costs of home ownership. Use online calculators to estimate property taxes and insurance premiums. Get quotes from insurance providers and check HOA dues for the properties you're interested in. Create a detailed budget that includes all your expenses, ensuring you can comfortably afford your monthly payments. Choose the right property for negotiation power. Here's the secret to winning in today's market. Not every house has multiple offers. Focus on homes where the seller has been waiting for an offer, and you'll have more room to negotiate. This can include asking the seller to cover closing costs, negotiating for home repairs or upgrades, or requesting concessions like the seller covering your rate buy down or paying HOA fees for the first year. Work with a real estate expert who knows the market. Real estate is hyper-local, and an experienced agent can help you uncover opportunities you might not find on your own. I help my clients analyze days on market trends, price reductions, and homes with motivated sellers. These are the hidden gems that give you an edge. Make an offer that stands out. If you're bidding on a hot property, you need a strong strategy. Be pre-approved, not just pre-qualified. So sellers know you're serious. Offer flexible terms like letting the seller choose the closing date or rent back or anything else that will make your offer attractive to the seller. Include an escalation clause if you're willing to outbid other offers by a certain amount. An escalation clause states that you're willing to pay a specific amount over the highest competing offer, up to a maximum price. This shows the seller you're serious and helps you avoid losing out on a slightly higher bid. Now let's break down an escalation clause with a practical example. Imagine you're bidding on a home listed for $500,000. You're willing to go higher, but you don't want to overpay. You could include an escalation clause like this. Buyer agrees to increase their offer by $2,000 above the highest bona fide competing offer, up to a maximum purchase price of $520,000. Seller must provide a copy of the competing offer to the buyer. Here's how it works. If the highest competing offer is $510,000, your offer automatically increases to $512,000. If the highest competing offer is $518,000, your offer increases to $520,000, which is your maximum. If there are no competing offers, your initial offer of $500,000 stands. This clause protects you from overpaying while still giving you a competitive edge. It also ensures transparency, as the seller must provide proof of the competing offer. But remember, you don't always need to compete. In many cases, patience and good research can land you a better deal on a less competitive property. Think long term. I know it's easy to get overwhelmed, but buying a home is a long-term investment. Don't stretch your budget too thin for a perfect house. Instead, focus on the essentials and think about how the home fits your future. Real estate is one of the best ways to build wealth, but it's also about finding a place to build memories. I hope this gave you a clearer picture of how to buy a home in today's market. If you have questions or need guidance, I'm here to help. Northern Virginia is full of opportunities, and together we can find the right one for you. Don't forget to like, subscribe, and turn on your notifications so you're always updated with the latest tips. And for those of you ready to dive into the Northern Virginia market, I'm here to offer the expertise you need to secure your ideal home. Thanks for watching today's episode of Smart Moves with Vibha. We've covered essential strategies for navigating the challenging home buying process in 2025, from exploring financing options like rate buydowns and ARMs to working smartly with sellers and selecting the right property. Remember, thinking long-term and making informed decisions can help you succeed in this competitive market. See you in the next video, where we'll explore even more ways to make your real estate journey smooth and successful.